Something extraordinary is brewing beneath the surface of Britain's economy, and few are prepared for the shock it could unleash. The pound sterling, once a global symbol of stability, now stands on the edge of a dangerous cliff. Inflation refuses to cool, growth is slowing, and investors are quietly shifting their money away from London's markets. Behind polished speeches and reassuring forecasts, the foundations are cracking. Every data release, every policy hint, now carries the potential to ignite a slide that could reshape the UK's financial landscape. The question isn't if the pound will fall, it's how fast. Number 1. Sticky inflation and the real yield squeeze. The United Kingdom's inflation problem remains more persistent than many assume. Latest figures show consumer price inflation around 3.8%, and underlying core inflation still close to 3.9%, placing the UK among the highest in the G7. This hasn't escaped the attention of global investors. When inflation exceeds expectations, the real return on assets, denominated in pounds, diminishes. Foreign holders of sterling assets begin to demand higher compensation or simply shift to alternative currencies offering better value. As inflation remains elevated and real yields shrink, the appeal of the pound weakens. Compounding the issue is a narrowing differential between nominal yields and inflation. The central bank has maintained interest rates at elevated levels, yet the margin between those rates and inflation is shrinking. That margin, the real yield, is what global investors monitor. If the Bank of England holds rates constant while inflation remains high or rises, the real yield turns negative. In such a scenario, capital flows out of sterling-denominated assets, triggering pressure on the currency. It is a simple arithmetic event. High inflation erodes purchasing power, and yields that don't keep up make holding the pound less attractive. For 2026, if inflation remains sticky while other major economies reduce theirs, the pound is especially vulnerable. Many investors are comparing the UK with the Federal Reserve in the US and the European Central Bank in the Eurozone, where inflation may ease faster. If the UK lags behind, the relative real yield gap opens in favour of other currencies, further weakening the pound. Under such conditions, the pound could face a sharp drop rather than a gradual slide, as sentiment shifts and derivatives markets begin pricing in larger risk. Number 2. Rate differential risk between BOE, Fed, and ECB. The strength of any currency often reflects its interest rate advantage over others. When the Bank of England is expected to cut rates faster than the Federal Reserve or the European Central Bank, investors reallocate funds to markets offering higher returns. By late 2025, markets were already pricing that the BOE could reduce rates to around 4%, while the Fed might hold above 4.75%. This changing rate differential is critical. It dictates the carry trade, where global investors borrow in lower yielding currencies to invest in higher yielding ones. Once that yield premium on the pound erodes, the currency loses its natural support from foreign capital flows. If the BOE turns more dovish due to domestic stagnation, while the Fed and ECB remain cautious against cutting too soon, a clear divergence forms. Traders seeking yield will exit sterling positions and move toward the dollar or euro. This dynamic has already been visible. Sterling posted one of its weakest months in recent memory, touching 2.5-year lows against the euro. The underlying message from markets is that confidence depends not only on growth prospects, but also on monetary policy alignment. An aggressive cut cycle by the BOE, even if meant to support households and businesses, could unintentionally weaken the currency further. For 2026, much hinges on whether the BOE can balance easing inflation pressure without triggering excessive capital flight. If global risk appetite shrinks and the UK offers smaller yields than competing economies, the pound's downside accelerates. Currency traders react quickly to shifts in interest rate expectations, and once that sentiment turns, momentum can be brutal. Without a clear signal of stability or coordinated policy support, Rate differential weakness may become one of the pound's largest vulnerabilities next year. Number 3, the twin deficit threat, fiscal and external imbalances. The United Kingdom has long struggled with two intertwined weaknesses, a fiscal deficit and a current account deficit. Both represent an economy that spends more than it earns, relying on constant foreign financing to sustain its balance. Public debt now hovers near 95% of GDP, while the budget shortfall remains elevated due to higher welfare costs, sluggish productivity, and persistent defence and infrastructure spending. When markets perceive that government borrowing is expanding faster than growth, they start questioning the country's fiscal credibility. Rising debt servicing costs, especially at higher interest rates, can quickly translate into a weaker pound as investors demand extra compensation to hold British assets. The external side of the equation is equally concerning. The current account deficit, sitting close to 3.8% of GDP, highlights the nation's dependence on foreign capital to fund imports and investment. This structural gap means the UK must attract steady inflows into gilts, equities, or property simply to maintain currency stability. If global conditions tighten or investors lose confidence, those inflows dry up. A smaller pool of buyers for UK assets immediately increases pressure on sterling. This mechanism makes the currency highly sensitive to sentiment shifts, particularly when global liquidity contracts. The risk in 2026 lies in these two deficits moving together. A wider fiscal shortfall paired with a deteriorating trade position amplifies vulnerability. Should borrowing costs spike or demand at government bond auctions weaken, yields rise sharply, making debt more expensive and triggering currency sell-offs. Economies with twin deficits often experience swift market corrections when investor patience fades. For Britain, maintaining credibility through disciplined spending and balanced trade will be essential to prevent these twin pressures from converging into a full-scale sterling crisis. Number 4. Weak productivity and slowing economic growth. Another major drag threatening the pound in 2026 is the UK's chronically weak productivity and slowing economic momentum. Forecasts from the Office for Budget Responsibility and KPMG project growth between 1.1 and 1.9% in 2026, barely above stagnation. Low productivity means businesses produce less output for each hour worked, which limits wage growth, investment, and competitiveness. When productivity lags behind peers like the United States or Germany, foreign investors see fewer long-term returns in Britain. That perception drives them to seek more dynamic markets, reducing capital inflows and weakening the currency's foundation. A slow-growing economy is often seen as less capable of supporting strong interest rates, making sterling more vulnerable to downward pressure. Behind these numbers are structural challenges: aging infrastructure, underinvestment in technology, and labour shortages following Brexit-related migration changes. Many small and medium enterprises struggle to access affordable credit, which restricts innovation and expansion. The result is an economy running below its potential, with fragile consumer confidence and flat industrial output. Such an environment makes it difficult for the Bank of England to raise rates or maintain a firm monetary stance, further eroding investor appeal. By 2026, if productivity reforms fail to materialise and growth continues to drift, the UK risks entering a cycle where weak performance itself fuels currency depreciation. As the pound drops, import costs rise, feeding inflation and making the real economy even less competitive. Investors watch this feedback loop closely. Once they sense that Britain's growth problem is structural rather than temporary, they reduce exposure to sterling assets. Unless significant improvements in productivity and innovation occur soon, the pound may remain caught in a long-term downward trajectory driven by its own economic inertia. Number 5. Gilt market fragility and financial stability risks. The memory of the 2022 gilt market crisis still haunts investors. Back then, sudden yield spikes nearly broke pension funds and forced the Bank of England into emergency bond purchases. While new safeguards have been introduced, such as the BOE's contingent repo facility and tighter oversight of liability-driven investment (LDI) funds, vulnerabilities remain. The gilt market is still dominated by non-bank institutions that rely heavily on leverage. If yields rise abruptly due to policy missteps or fiscal slippage, margin calls could trigger forced selling, creating a chain reaction that pushes yields even higher and sends the pound tumbling. Confidence in Britain's financial architecture is therefore a vital line of defence. The fragility lies in liquidity, not just leverage. Gilt markets are deep, but they can freeze quickly under stress. If global investors lose faith in UK debt sustainability or fear renewed volatility, they might demand higher returns to hold gilts, weakening sterling further. Any perception that the BOE must again act as a backstop could remind markets of 2022's instability. That association alone can amplify speculative pressure. Stability in the bond market is crucial because it signals overall investor confidence in the UK's macroeconomic management. Heading into 2026, the risk is that a combination of high borrowing needs, rising yields, and limited buyer appetite ignites another liquidity squeeze. Even a mild fiscal surprise or unexpected inflation print could spark volatility. The BOE would then face a painful dilemma: intervene and risk moral hazard, or stay back and watch the currency fall. Investors remember that when gilts wobble, the pound rarely escapes unscathed. A renewed shock in this market could easily become the spark that reignites broader fears of a sterling collapse. Number 6. Political uncertainty and policy instability. Political credibility has become an increasingly important driver of the pound's value. With a general election looming in 2026, markets are already nervous about the future direction of economic policy. Investors crave predictability, and any sign of fiscal populism or inconsistent policymaking can send shockwaves through the currency market. The UK's recent political cycles, from rapid leadership changes to conflicting fiscal strategies, have left investors wary of instability. When global funds perceive that fiscal discipline might give way to short-term political promises, they begin pricing a risk premium into the pound, effectively lowering its international standing. Budgetary tensions amplify these fears. Public borrowing continues to overshoot forecasts, while departments face spending pressures in health, defence, and energy subsidies. If the next government signals expansive fiscal plans without credible revenue sources, gilt investors may pull back, pushing bond yields higher and dragging sterling down. Conversely, if fiscal tightening arrives too aggressively, it can stifle growth and still weaken the pound through recessionary expectations. The delicate balance between fiscal prudence and growth support remains extremely fragile. A single policy misstep or poorly received budget announcement could trigger swift market reactions. Heading into 2026, investors will closely watch for policy coherence between the Treasury and the Bank of England. Mixed messages, one easing while the other tightens, often amplify uncertainty. If confidence in the UK's leadership or long-term fiscal framework weakens further, it won't just be politics making headlines. It will be the pound itself taking the hit. Political stability, clear communication, and credible fiscal planning will determine whether the next administration restores confidence or accelerates a currency downturn that's already in motion. Number 7. Housing market pressures and household debt risks. The British housing market, once a cornerstone of economic confidence, is now flashing warning signals that could weigh heavily on the pound in 2026. After years of price inflation, affordability has eroded, leaving households exposed to even small interest rate changes. While mortgage approvals recently showed slight improvement, the overall cost of borrowing remains historically high, and arrears are rising across several regions. A correction in property values would hit consumer wealth, reduce spending, and slow growth further. That combination, weaker consumption, sluggish GDP, and falling asset prices, often translates into a softer currency as investors anticipate lower future returns on UK assets. Household debt is another vulnerability. Many borrowers refinanced during the era of ultra-low rates and are now rolling onto far higher repayments. This squeeze on disposable income limits economic resilience just as external risks grow. As more households cut spending to service debt, domestic demand falters. Retail and service sectors, which make up the bulk of the UK economy, already show signs of fatigue. That leaves the government with fewer fiscal tools to stimulate growth without worsening its deficit. A scenario that unsettles both bond and currency markets. By 2026, if housing prices fall sharply or unemployment rises, the feedback loop could accelerate. Lower home values reduce collateral for borrowing, banks tighten lending, and the economy slows further. Investors see that cycle as a warning that the UK's internal demand engine is stalling. A weakening housing market doesn't just affect homeowners, it sends a message globally that financial stability is slipping. If sentiment shifts from resilience to vulnerability, the pound could quickly become the barometer of a broader economic downturn led by over-leveraged households and an exhausted property sector. Number 8. Terms of trade shocks and imported inflation risks. The United Kingdom remains heavily exposed to imported energy and goods, making its terms of trade a critical determinant of currency strength. When global oil, gas, or shipping prices rise, Britain's import bill swells, worsening its current account position and fueling inflation. Energy and transport costs still represent a large portion of the consumer basket, and even modest price spikes can reignite inflationary pressures. Because the UK produces relatively little of its own energy, these external shocks directly hit household bills and manufacturing costs. If 2026 brings renewed volatility in commodity markets, such as tensions in the Middle East or disruptions in maritime trade routes, the resulting surge in import prices could again push inflation above target, forcing investors to reassess sterling's stability. Imported inflation creates a painful policy dilemma for the Bank of England. Tightening monetary policy to curb prices risks suffocating already weak growth, while easing too soon could devalue the pound further. The central bank's every move will be scrutinised for its effect on currency confidence. Meanwhile, businesses face thinner profit margins as input costs rise, and consumers bear the brunt of higher retail prices. This cycle diminishes purchasing power, reduces domestic demand, and compounds the impression that the UK economy cannot shield itself from global volatility. If external prices remain high while exports stagnate, the terms of trade balance deteriorates, undermining the pound's intrinsic value. Historically, such conditions have led to sharp, self-reinforcing sell-offs as traders anticipate persistent current account weakness. A country that imports inflation but cannot generate export-led growth often finds its currency sliding regardless of policy efforts. In 2026, sterling's fate could hinge on whether the UK can diversify energy supplies, stabilise logistics costs, and prevent another wave of imported price shocks from eroding economic credibility. Number 9. Market sentiment and technical momentum risks. Beyond economics, the pound's value is also shaped by market psychology and technical trading patterns. In late 2025, sterling entered a period of heightened volatility after falling to multi-year lows against both the dollar and the euro. Currency traders increasingly rely on momentum strategies, meaning that once a downward move begins, automated systems and hedge funds often amplify it. When sentiment turns bearish, even neutral data can spark additional selling. As speculative positions build, the currency becomes vulnerable to sharp and self-reinforcing drops. This behavior transforms a slow depreciation into a fast-moving sell-off that can resemble a crisis even without fresh economic news. Institutional flows also play a role. Many global funds use sterling exposure as a proxy for European risk, making the pound especially sensitive to global equity swings or commodity price shocks. When investors retreat from riskier assets, they typically move capital into the US dollar or Swiss franc, leaving the pound under renewed pressure. Technical factors, such as breach support levels on long-term charts, attract short sellers and further weaken market confidence. Once those thresholds break, large stop-loss orders can cascade through trading systems, compounding volatility within hours. For 2026, traders will watch whether the Bank of England's tone, inflation trajectory, and fiscal stability can restore confidence before a deeper trend develops. If political or macroeconomic news remains negative, sentiment could easily deteriorate again. The danger lies not only in fundamentals, but also in perception. Markets move on fear faster than facts. Without consistent policy signals and steady growth data to shift momentum, sterling may continue trading as a speculative asset rather than a stable store of value, leaving it exposed to sudden, sentiment-driven crashes that exceed economic justification. Number 10. The 2026 crash scenario. A true currency crash rarely stems from a single cause. It's the convergence of multiple weaknesses reaching a breaking point. For the pound, that danger could emerge if inflation remains above peers, the Bank of England cuts rates aggressively, and investor confidence in fiscal management erodes at the same time. Each of these forces alone strains the pound, but together they form a perfect storm. Persistent inflation destroys real returns. Lower rates discourage capital inflows, and fiscal doubt undermines trust in UK assets. Once investors see all three aligning, they move funds rapidly to safer currencies like the US dollar, accelerating sterling's fall. The structural imbalances make this convergence more likely. A widening current account deficit demands constant foreign financing, while large government borrowing leaves little fiscal room to respond if markets panic. Any sign of hesitation or miscommunication from policymakers could amplify outflows. A poor bond auction, a weak GDP print, or renewed political tension could all trigger a chain reaction. Higher gilt yields, reduced liquidity, and a sudden repricing of sterling in global markets. When confidence breaks, the correction tends to overshoot fundamentals, leading to a sharper decline than models predict. The 2026 risk lies in how quickly sentiment can shift from cautious optimism to crisis. Investors are already watching for signals: slowing growth, persistent inflation, or widening deficits. If these trends persist without credible policy anchors, the pound could face a steep disorderly drop reminiscent of past market dislocations. The challenge for the UK is not only avoiding each weakness individually, but preventing them from colliding. Without coordinated fiscal discipline, credible monetary policy, and stronger growth, the scenario that analysts fear, a full-scale sterling crash, may no longer be theoretical but alarmingly close to real. The warning lights for the pound sterling are flashing brighter than ever. Years of structural imbalance, from weak productivity and heavy borrowing to fragile trade flows, have created a currency vulnerable to both domestic and global shocks. If inflation remains sticky while growth falters, the UK risks entering a cycle that weakens its competitiveness and investor confidence simultaneously. Each policy move by the Bank of England, each fiscal statement from the government, will now carry disproportionate weight. The pound's value is no longer just a reflection of economics. It's a mirror of credibility, discipline, and trust in Britain's future. A potential crash in 2026 would not simply affect exchange rates. It could ripple across energy prices, mortgages, imports, and household savings. The currency that once powered an empire might soon become a measure of national fragility. Whether that scenario becomes reality depends on how swiftly leaders act to restore confidence and rebuild growth momentum before markets make the judgment themselves. If you want to stay ahead of the coming financial storm, subscribe now, turn on notifications, and share your thoughts in the comments. More insights on the UK's economic turning points are coming, and you won't want to miss them.